Matters Radio Network.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled The Key Numbers to Know for 2024. Mike, for retirees, no number is more important than that Social Security cost of living adjustment. What are we seeing in terms of the bump up in Social Security payments next year?
Yeah, well, fortunately, most individuals will be receiving an increased payment on Social Security. Unfortunately, it's not going to really come close to what they saw in 2023. So in 2023, Social Security recipients saw a nice bump up of over 8.5%. Coming next year, you'll see a much more modest increase in the 3.2% range on those Social Security benefits.
Now, the other piece here is that most people collecting Social Security also have their Medicare Part B premiums taken out of those payments each month. What's happening on that front?
Yeah, that's correct. And, that was one of the real kind of strange things about 2023 is not only did we see very big cost of living adjustments, but Medicare premiums actually came down. Next year, we're reversing that trend. We're seeing Medicare premiums go from about $165 a month up to $175. And so that's going to be a further drag on those Social Security checks. The Medicare Part B one is a bit of a tricky subject, too, because those are income-based. If you're not familiar with IRMA, a good thing to familiarize yourself with, especially if you're selling a home or investment portfolio.
Our guide this month is titled The Key Numbers to Know for 2024. And it includes a discussion of these topics and more. There are two ways to request it. The first is by calling 800-393-4001. The second is by going to ArmstrongAdvisory.com. That phone number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck and Mark with you here, and want to kick things off today with a discussion about not necessarily what the economy looks like today, but more, hey, what does it look like over the next 5, 7, 10 years? Not the specific path, but in general, the composition of it. And this is kicked off by a piece in the Wall Street Journal today. It has the headline, "Meet the New Economy Just Like the Old Economy." And it's making the case, Mark, that, hey, over the next 7 to 10 years, yes, we went through this, first COVID supply-related shock, then we went through this inflationary period. Now we're starting to return to a more normal set of economic conditions. And this is laying out that, hey, the next 5 to 7 years might look an awful lot like the 2010s as opposed to what we just went through for the last 2 to 3 years. Your thoughts?
Yeah, assuming that the backdrop is exactly the same. You can never say for sure. And I know you know this, Chuck. People listening know this. The economy's constantly buffeted by small disturbances, you could say. There is some underlying trend in economic growth. If you look at gross domestic product, which is how economists measure the size of the economy, the size of the growth of the economy, not the stock, but the flow, it makes for a nice line over time, a line that indicates growth that is actually exponential. It's compounded, and it's a beautiful, nice, and if you step back enough, it even looks smooth. That's the long-term trend. There are disturbances to that trend. The financial crisis, the wars. I mean, you pick your favorite geopolitical or economic upheaval, but the direction has been up over the sweep of history since the Industrial Revolution. Forecasting it is really hard to do over the short term, forecasting the little wiggles. But as long as the labor force continues to grow, and as long as there's still technological innovation, and we presume that there will be, then that upward trend will continue. But it's the wiggles that move markets, and they're impossible to forecast. So I guess Ip's conclusion is correct as far as it goes. You could take a ruler and just extend the current trend line. Actually, there are methods that are a lot more sophisticated than that, but not necessarily any better than that.
What about the piece that I think a lot of people at the moment are still struggling to get their heads around is, okay, so we can understand it just from a general growth perspective in terms of, sure, if you have population growth, that looks a lot like pre-pandemic, okay, that makes some sense. If you've got, productivity growth that looks a lot like pre-pandemic, okay, that makes some sense. How does the inflationary picture fit in here? Because I know for a lot of folks that kind of feels different from pre-pandemic, and they're wondering if it will get back there.
I'm going to be a little flip and say it doesn't. In the long run, money's neutral. It doesn't affect the natural rate of unemployment or potential output. It doesn't affect real variables. This was Milton Friedman. I know many listeners know that name because he was such a prominent popularizer in the 70s and 80s. But he rammed home the observation that's it's an age-old one. It's not attributable to him. But, money doesn't matter. It does in the short run when some prices are sticky and others move by a lot. So oil jumps. Everything else is sticky. That means the average price goes up. Supply chains become unkinked. Supply chain related prices come down. Everything else is sticky. You have disinflation. That's been the story of the past 18 months. I'm talking about long run because that's what this article was about, Chuck, and that's what your question's about. Long run money shouldn't make a difference unless, of course, inflation causes political upheaval, which maybe changes our political system somehow. That's never happened here in the United States. There have been big periods of inflation that resulted in new currency regimes, but never political upheaval. But there are examples elsewhere of inflation causing political disturbance, which changed institutions and impacted long-run growth. Other than that, inflation doesn't matter. That is a big other than that. That's not something that should just be dismissed. But I'll just be cavalier and say, other than that, inflation doesn't matter in the long run.
What about from a policy perspective? And, I like to always point out that, every 4 years we end up with an election. And despite what we've been hearing for now almost the last 23 years, it doesn't really seem like anyone is serious about addressing the long-run deficits or even at this point growing short-term annual deficits. How do things like those potentially impact what the economy looks like over the next 7 to 10 years?
It could hamstring the government's ability to respond to a deep recession, and that could make people less employable. So let me give a very specific example. We continue to run these recklessly large deficits as we are today, even during an economic expansion, which is why I call them reckless. That may tie our hands. The bond market, which is global, may eventually tie our fiscal hands at a time when we really need to spend money to support, say, the unemployed or something like that, to pay for the automatic stabilizers that kick in when the economy slows. That could result in prolonged high unemployment, which could affect longer-term growth. That's one example of the way high deficits, because they tie your hands when you want to and need to spend money, could make a recession longer and painful. And there are some economists who use the word hysteresis, which sounds fancy, but it just means that the future is dependent on the past. This notion of hysteresis in economics means the higher unemployment today leads to higher unemployment tomorrow because people become less employable. Their skills erode. This notion became very popular when explaining the high unemployment in Europe in the 1980s. Everybody remembers Europe being the sick man of the Western world. And they had very high, chronically high, like 10% unemployment, even during boom years. What the heck is going on? That's where economists came up with this theory of persistence and unemployment is a simpler way to think about it, to explain it. So maybe that, Chuck, is a potentially adverse result of reckless deficits. And I say that because we're in an expansion. You should be running tighter fiscal policy than you're running today.
One of the things that I always like to do is I like to go back and say, okay, what did when we were making these long run projections, are they actually accurate in any way, shape, or form as far as what we may see? No. And I always like to go back to the CBO projections in particular from 10 years ago and say, okay, what were they projecting then, and what did they think was going to end up happening? And in fact, what you pretty consistently see is that they're not accurate in any way, shape, or form for two major reasons. The first is oftentimes policy changes within that 10-year period, sometimes quite dramatically. And the other piece is they never anticipate anything going wrong. You never see a recession priced into a CBO projection. And that's because you can't predict what year a recession is going to happen or how deep it may be. So it's dumb to project one. But you always end up with these things where it's like, oh, yeah, here's what we thought was going to go on, and here's where it actually ended up. So just as an example, when we look at the CBO projections from February of 2014, so almost 10 years ago, for fiscal year 2023, they were projecting revenues at $4.7 billion, outlays at $5.7, deficit of about $1 trillion. That's where they thought we would come in this year. Interestingly enough, this is actually one of the times that they're closer. If you look at where they came in, revenues, come in at $4.43 trillion. Okay, it's 5% light, but 5% wrong over a 10-year period. That's pretty close. On the spending side, we came in at $6.13 trillion. That is about $400 billion light in their projection. So the deficit this year is about $1.7 trillion compared to projections of $1 trillion. When you actually add it all together, they were almost off by like 70% as far as, how big it was going to be just this year. And then you, again, talk about the compounding effects of these when you do this over and over and run 5 or 6% deficits instead of 3 or 4. That's the kind of thing that, again, you talk about how this ends up influencing thing in the long run, and you get there very quickly. I mean, just as an example here, they said that the amount of – is this the amount of the percentage? I don't know. There was another thing that I was looking at, but I can't make sense out of it. So in any case, these long-run projections, whether they're being done by the CBO or, an economic think tank or whatever, I think they're good to establish, hey, here's the trend line that we are on, but I don't think they should be thought of as, here's where we're going to be in 10 years, because stuff happens.
No, I don't think anybody uses them that way either. They're used for planning and budgeting.
Yes.
But look, I don't have a better guess, and we always fall back on CEO estimates when we're projecting. We work in capital markets here. So when you're projecting, say, equity returns, you have to tie that to economic growth somehow. And
Sure.
It's pretty safe to assume that growth will continue on the same roughly path. The line will have roughly the same slope that it has today. You wouldn't have any basis for making a prediction otherwise, though the slope could tip up, meaning higher growth, or down, lower growth due to some shock that persists. Like you said, it's impossible to say.
Let's take a quick break here. When we come back, talk about, the Fed appears to have pivoted towards some easier policy coming in 2024. Why are people so confused about that? We'll discuss when we return.
The latest news on inflation and how the markets are reacting every morning, right here on the Financial Exchange Radio Network.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Early estate planning is crucial if you want to avoid massive tax consequences and protect your assets. Cushing & Dolan are experts in estate planning and taxation, and their new free guide can help you do just that. It's called A Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. In it, you'll learn how to keep your assets away from the nursing home while reducing and potentially eliminating your estate taxes. You've worked hard to provide for your family, so if you haven't done your planning yet, call Cushing & Dolan today at 866-848-5699 and get this free guide called The Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. That's 866-848-5699. Or you can request your copy online from our website, legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I'm no stranger to the military community. My late uncle, Albert Warner, served proudly in the 1st Marine Division in World War II and gave the ultimate sacrifice for his country. I am surrounded by a family of disabled veterans, including my father, Victor, and brother, Timothy. I am a veteran, and I have dedicated my business and my life to helping veterans. My company, Veterans Development Corporation, works to help disabled veterans every day, and it's one of the key reasons why I'm such a big supporter of Dan Stack and the Disabled American Veterans Department of Massachusetts. I am so thrilled to be proudly partnered with this year's DAV 5K.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit dav5k.boston. Miss any of the show? You can catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. The cold weather is here, and if you haven't done it yet, now's the perfect time to start planning your winter getaway to the U.S. Virgin Islands. Explore St. Croix, St. Thomas, or St. John and enjoy incredible beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com.
Mark, there's a piece in the Wall Street Journal that's talking about how people are all confused now about when and how fast the Fed's going to cut. And
I wonder why.
Well, so here's the thing. Haven't people been confused about this for a while?
True,
I mean, the market was
but
pricing in cuts all year this year.
Yeah, but the confusion's been amplified by contradictory remarks following Powell's press conference, in which he chose inexplicably to goose markets, both bond and stock. It's been followed by a couple of policymakers seemingly walking it back a little. One sympathizes with their attempts. I don't think the Fed intended to stimulate financial conditions, thus making their job of getting core inflation down, underlying inflation down, making it harder. But the Fed tried to backtrack, it seems, last week, and they seemed in aggregate a little incoherent as a result.
I'm trying to figure this out here because there's something really interesting afoot in my mind. And what it is, if you look at, I often refer to it as the spaghetti chart, the projections where if you look at the beginning of each year from 2000 through 2019, about where people projected the Fed funds rate would go, you always had these little lines going up saying, hey, this is the year the Fed's going to raise rates. And the Fed very seldom did. We only had a couple instances where they actually did. I think it was 2005 through 2007 you had rates going up, and then you had 2017 through 2018 when rates were going up. Other than that, the Fed was always, nope, we're either good or we're cutting. Now, over the last year, again, it's just 1 year, but now it's running out into next year now. It's 2 years in a row now where markets are saying, yeah, the Fed's going to cut. And so this year you've got that spaghetti line pointing down when really it was, the Fed didn't cut this year. And so I'm trying to figure out what has happened psychologically where for the 2 decades before COVID hit, markets were saying, yep, the Fed's going to be raising rates this year, even though inflation was not a problem for any prolonged period of time. And now you actually have inflation running higher than the Fed wants, and all markets want to do is say, yep, now's when the Fed's going to cut. Well, I'm trying to figure out the group psychology that has happened here because there's something different on that front. That might be a conversation for a different day.
The notion that the Fed would raise rates from 2009 on was predicated on hope that the economy would break out of the languid state that it had been in for really years after the financial crisis. The Fed hiking would have meant that growth had resumed to something like pre-global financial crisis trend, and that inflation might actually perk up. There's that relationship between a decrease in slack and inflation that has seemingly gone away in the past couple of years as we've had a big disinflation despite a very tight economy. But it was predicated, that view, that rates were going to go up in 2010, 2011, 2012. And the Fed was saying, just a couple of years now, we're going to raise rates. Or next year, we look likely to, they were hoping that economic growth would pick up enough that it would put pressure on inflation. So that was predicated on hope. Now, sort of the opposite psychology, I guess, has taken hold. Rates seem very high, even though in pre-financial crisis terms, they're not that high. A 5%, which is roughly where we are today, Fed funds rate would have looked positively normal, if not accommodating, in the 80s and most of the 90s, particularly when you've got core inflation remaining, and I don't just mean ex-food and energy, I mean by other measures of underlying inflation, remaining elevated. So the hope now, I guess, is that rates that seem high and stringent will come down and give equity markets, further room to run. We're up 25% this year. I don't know what more people want. But to me, it's just hope driven by asset management industry hype in some cases, or general hope for better economic conditions. Not that you can get much better in a statistical sense than we've had this year overall.
What about the fact, I know that you often like to talk about, look, people reference the 12-month rate of inflation, but what happened 12 months ago isn't necessarily relevant to today.
Not a good predictor.
The last 6 months of inflation data has generally shown both core and headline inflation pretty much floating around the high 2s to low 3s. Is there a case to be made that the Fed is simply saying, yeah, we expect this to continue, and if it does, we don't need to keep rates this high because those long-run 1-year inflation numbers are going to come down and look better, and we don't need rates to be at 5% if inflation is getting down into the high 2s.
Yeah, if you expect more disinflation, sure, you would at that point have room to cut interest rates. They might be looking at the wrong measure of core inflation, and we talk about headline inflation, which is all items, an average of all prices, which is what most people can relate to, I think. And sometimes we talk about core inflation, which strictly defined is headline less food and energy. Why? Because food and energy are subject to big swings that the Fed really can't control. They're very, very flexible, unlike other prices. That measure of core might not be appropriate, however. Food and energy prices have been bringing down headline inflation by a lot over the past year. So excluding them from core makes sense. Oh, energy, I should say. Food, less so. But there's other stuff that traditional core inflation doesn't. I'm going off on a little bit of a tangent here. I promise I'll bring this back to your point. There are other measures of core inflation that strip out not just food and energy, which is a little bit arbitrary if you think about it. I buy other stuff too. But measures like median, which we talk about from time to time, that show inflation remaining significantly elevated, 3 to 4%, way above the Fed's goal, that at any other point in recent economic history would have warranted additional tightening, not talk of lowering rates. So the picture is unusually unclear right now. And again, the Fed's actions over the past few weeks to me are baffling and possibly not at all helpful.
Quick break here. Wall Street Watch and Ask Todd are next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Marc Vanner.
I enlisted in the Marine Corps when I was 18 years old, joining a long line of family members who also served our country. After my service, I connected with the VA healthcare systems, where I attended meetings with disabled veterans and learned for the first time about the DAV. I was so impressed with the work they do to help millions of veterans, including providing necessary services like transportation, education, and financial opportunities. communities. Today, I stand a proud partner of the DAV and the 2023 DAV 5K. My company, Veterans Development Corporation, is a general contracting firm working with many disabled veterans, and I hope that by sharing my story, many other disabled veterans will be able to reach their goals once they conclude their service.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit dav5k.boston. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is Tucker Silva of the Financial Exchange, and I'm joined today by estate planning attorney Todd Lutsky from the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about estate tax reduction and asset protection strategies that can help reduce or eliminate your estate taxes. Todd, there have been major changes with the Massachusetts exemption amounts this year. What is the new exemption for Massachusetts? And does that mean that a married couple living in Mass with $4 million in assets could eliminate their estate taxes?
Well, that is true. But let me expand on it a little bit. There is good news. Massachusetts' estate tax exemption has been increased from $1 million per person to $2 million per person, which in essence is great news because now with planning, and remember folks, with planning, a married couple can effectively shelter $4 million from estate taxes, whereas before, with planning, you could only shelter $2 million from estate taxes. But remember, if you don't do your planning and you don't have a trust in place, you will end up wasting one of those exemptions. And so by not planning now, although the exemption went up, which is good news, by not planning, it's twice as costly for people if they don't get their trust done and their planning done. You're just making a much bigger gift to the state of Massachusetts by not doing your planning.
The law firm of Cushing & Dolan has been helping families like yours for more than 30 years. Request your copy of Todd's brand new guide. It's called A Tale of Two Objectives, Reducing Estate Tax and Increasing Asset Protection, right now by calling 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are in mixed territory one day after the Dow notched its 9th straight day in positive territory. Right now, the Dow is off by 25 points. S&P 500 is up by 5. And the NASDAQ up by over 1/3% or 58 points. Russell 2000 is also up by 1/3%. 10-year Treasury yield down by 1 basis point, now at 3.90%. And crude oil up nearly 1.5%, trading just below $75 a barrel. FedEx shares down by 10% after the shipping and delivery giant fell short of estimates in its fiscal second quarter, as its express unit was impacted by lower demand. FedEx lowered its revenue forecast as a result of weaker demand, saying it expects a low single-digit decline in revenue for the fiscal year. This marks the second straight quarter the company has lowered its sales outlook. UPS is also seeing sympathy losses on the day. Meanwhile, General Mills posted softer than expected fiscal second quarter results, where the food products company generated $5.14 billion in revenue, short of street forecasts of $5.35 billion. General Mills shares off by 2.5%. Elsewhere in Winnebago, down by 1.5%. After the RV maker missed quarterly earnings forecast, while its revenue plunged about 20% year over year. And Wells Fargo downgraded Salesforce to equal weight from overweight as the bank evaluates stocks that will benefit from what it expects will be a steady shift toward growth in 2024. Salesforce shares are off by about 0.25%. I'm Tucker Silva, and that's Wall Street Watch.
This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
We're joined now by Todd Lutsky from the law firm of Cushing and Dolan. We call the segment Ask Todd because right here on the air you get to ask Todd your questions about your estate plan. Our number here is 888-205-2263. That is the studio line to call. So get calling so that Todd can answer your questions live on the air. That number again is 888-205-2263. One more time. 888-205-2263. Mr. Lutsky, how are you today?
I'm doing well, and you?
Doing well. I had an interesting experience yesterday, though. I'm out at a bar last night. You know, it's a Monday. Was it Tuesday night? Everything's
Yeah.
big night, right?
Drinking.
And this really bossy guy walks into the bar.
Yeah.
And he orders everyone around.
Well, that's nice. No. Oh.
See, it's you. When you deliver a joke, you just got to let it sit for a second. You got to be patient. I'm glad we did that.
I waited. I walked right into that one.
Oh, that was fantastic, Todd. Let's talk a little bit about estate planning instead of bossy people at bars.
Okay.
Let's say someone has done an estate plan. They've gone out. They've maybe done trust work. At the very least, they've put some legal documents together. It's getting colder now. Let's say this is the year they say, you know what, I'm getting out of New England. I'm moving to Carolina, Arizona, Florida, wherever it may be. Does that person have to go and do completely new legal work just because they've moved to a new state?
Yeah, great question. It happens a lot, and a lot of people, whether it's the time of year or whether it's, as I see it, just people who have been living somewhere for a while and have decided to change residency, and you're right, it's cold, and they want to go where it's warm, perhaps. Or they simply want to escape estate taxes here in Mass. That's a driving force as well.
Sure.
And so to make that move, if you've done your planning, you should, at least revisit your plan, call your lawyer, and talk to them about, what you're doing. I would say that likely your trust, be it a revocable trust, which many of you might have, or an irrevocable trust if we're talking about protecting assets from the cost of long-term care, either one, you likely will not have to change that. Now, that's the heavy lifting, right? That's the big piece of the estate plan. That's obviously the bigger cost piece, and it carries all the weight in terms of what you're doing from an estate planning standpoint. You probably can have that stay the way it is. Now, Some of you might say, listen, I want to change the situs. What the heck is that? You can go in your document and say, I now want it governed by the laws of the state of, let's say, Florida. So, or New Hampshire are two popular places. So you can do that. That's called changing the situs. Or you don't even have to. You can leave the situs Massachusetts. That just means that the laws of Massachusetts will govern that trust document. That's okay. Remember, federally, it's the same in every state. So you don't have to worry about that. And what I would change for you would be the basic documents. Let's say you go to Florida. You want to make sure that you update your will, your healthcare proxy, your power of attorney, your living will, the HIPAA form. These are basic documents, important, but they tend to have a state format that you want to follow. So that's one reason to do it. And the final reason to do that is, remember, you're trying to prove to Massachusetts or whatever state you're leaving that you left. And you want them to show this is another aspect of your intent. Hey, look, I know I left. I've got a place here. I'm staying here. And look, I even changed not only my driver's license and voter registration, but I changed my estate planning documents, furthering your intent that you've made the move. So long-winded answer, but it's complicated when you change residency.
Just the right amount of wind, in my opinion. Talking with Todd Lutsky from the law firm of Cushing and Dolan. The studio line here, if you've got a question for Todd, is 888-205-2263. We're going to take a quick break right now, but when we come back, it's going to be right to your calls with Todd. That number is 888-205-2263. One last time, it's 888-205-2263. Quick break, then your questions with Todd.
Ask Todd with Todd Lutsky every Wednesday at 10:30, only here on the Financial Exchange Radio Network. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. As another new year approaches, we've put together a brand new free guide that will walk you through the key numbers you'll need to know for 2024, especially from a tax standpoint. This guide outlines the marginal tax brackets for both married couples and single individuals, and it includes details about the new standard deduction, information that will be pivotal for your financial planning strategy. We also explore other areas like Medicare Part B premiums and all the ways your Social Security benefits are taxed. Call us today at 800-393-4001 and request your free guide. The year may be ending, but it's not the time to put your financial needs on hold. Call us at 800-393-4001 to get your guide or request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Marc Vanner.
I served proudly in the Marine Corps from 1981 to 1984 and was honored to receive the U.S. Marine Corps Expeditionary Medal, one of the oldest decorations still issued to active duty personnel. I started Veterans Development Corporation to give back to the veteran community. Many of my employees are former veterans, and it is my distinct pleasure to work with them each and every day. This is why I'm so excited to be partnering with the Disabled American Veterans Department of Massachusetts on this year's DAV 5K. If not for the DAV, many of our disabled veterans would not have access to critical services that they need to live comfortably. I hope that by telling my story, many more of our veterans will achieve their goals and dreams post-service.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit DAV5K.Boston. Early estate planning is crucial if you want to avoid massive tax consequences and protect your assets. Cushing & Dolan are experts in estate planning and taxation, and their new free guide can help you do just that. It's called A Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. In it, you'll learn how to keep your assets away from the nursing home while reducing and potentially eliminating your estate taxes. You've worked hard to provide for your family, so if you haven't done your planning yet, call Cushing & Dolan today at 866-848-5699 and get this free guide called The Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. That's 866-848-5699. Or you can request your copy online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. You're listening to Ask Todd with Todd Lutsky on the Financial Exchange Radio Network.
Then you are on with Todd Lutsky.
Yes, hi. Quick question. And you may have answered this.
Mm-hmm.
If you live in Massachusetts and you have an irrevocable trust and you move to, say, New Hampshire or Florida or another state, does that trust dissolve or is it still enforceable? How does that work?
Yeah, no, you're right. That's exactly what we were talking about because that's a question that a lot of people have. No, it still works. You do not have to change the irrevocable trust. I mean, at the end of the day, a good way of explaining this would be, you come in, you do your estate planning, and in your case, you set up an irrevocable trust. Well, one of the reasons you set it up was to, get a 5-year clock started to protect assets from the nursing home. Well, if 3 years into my 5-year clock, I decide to move to Florida, you're telling me I have to start my 5-year clock over again? Or what if I'm older now? I don't want to have to risk getting past 5 years just because I moved, and I don't want to be tied to a state. If that was the case, no one would really do it. So absolutely, you do not need to change your irrevocable trust, but I would change those little documents, the will, the health care, the power of attorney, the HIPAA, etc., to show your intent, because I can tell you Massachusetts likes to check. They don't just believe that you're a non-resident. They will do their diligence to make sure that you've stayed out of this state 6 months in a day and changed other things like your driver's license and your voter registration and where do you file your federal income tax return, what address do you put on that federal form, then it better be the Florida address, and are you filing a non-resident mass return for any reason? If you happen to have income here, that's okay. Make sure those I's are dotted and T's are crossed. So hopefully that's helpful. But folks, overall, we are approaching, the getting close here to the end of the month and end of the year. The guide we're giving away is A Tale of Two Objectives, and it deals with these issues. So it deals with both, actually. It deals with the revocable trust, which is a way for you to understand the federal estate tax, the change in federal estate tax that's coming, and it shows how the revocable trusts work to reduce the estate tax and avoid the probate. You can even put your own formula, your own numbers in, your own estate numbers in and calculate it. It explains portability and how to use portability to your advantage of these unused exemptions. But most importantly, when I say it's a tale of two objectives, for all of you who want to avoid estate taxes and also want to protect assets from the nursing home, it talks about how an irrevocable trust accomplishes those objectives and finally explains the new Massachusetts estate tax exemption and how it works. Folks, it's really a guide for everyone. Call and get it, 866-848-5699, or LegalExchangeShow.com. A Tale of Two Objectives, 866-848-5699 or LegalExchangeShow.com.
Another call for you, Todd. We've got Lisa in Sandwich on the line. Lisa, what's your question for Todd Lutsky?
Just wanted to know if you have an investment property such as a rental, should you hold that in a separate trust versus with your personal assets to protect possible lawsuits or whatnot to protect your personal assets?
Yeah, you don't like those. You don't like those tenants suing you, and it does happen all the time. So, great question, and the answer is going to be yes, but in a different way. Let me explain. So, Lisa, for you example, or for anyone listening, you want to set up an estate plan. That's where you would start. You would come in and say, I want to set up, an estate plan. Okay, I want a revocable trust, and I want to put my assets in that revocable trust, and that would include your house. That would include your investment portfolio, your bank accounts, if it's revocable. Even irrevocable, you can fund it with all these same things. And so you do that, and you get it funded. You were saying, do I need a separate trust for the rental because I don't want to expose my other assets, all my personal assets, to this creditor? So it's not a separate trust. It's an LLC. So you need a limited liability company in order to put the rental property into it. So we still have the revocable trust over here, your estate planning trust, funded with all your other assets. But over here you have a LLC, and you put the property, deed it directly into there. Why? That's where the creditor protection comes from that you were looking for, Lisa. In other words, it says now if it's in the LLC and somebody gets hurt on the property, they're going to sue the owner of the property. Well, if the owner was you, Lisa, whether it's in your trust or not, they're going to go after all your personal assets because they're going to go after everything you own. But if it's in the LLC and the lawsuit comes, then they're going to sue the owner, which is the LLC, and not you, right? You are just a shareholder in the LLC, so they don't sue the shareholder, they sue the entity. And if the only item in that entity is the building, that's all they can get. So please keep your commercial umbrella insurance in place to cover that liability, but at least they don't sue you. Not to stop there, but then you take the shares of that LLC and deposit those into your revocable trust. So it's still in there, but in the form of a share rather than the actual asset, so that you still get to use it to avoid probate and or shelter estate taxes if need be. So hopefully that helps.
Todd, I've got one more for you, but we got to be quick. Angie and Spencer, what's your question for Todd Lutsky?
I have an RMD that I would like to get out of because I want that money to be liquid. They're out in Indiana. What can I do?
Well, I didn't quite understand. So you've received your required minimum distribution from your qualified plan. Is that what you're saying?
I have been for the last 17 years.
Good.
How can I make that money become liquid?
Well, when you take the RMD, it's usually already liquid cash, isn't it? You got the money. And so if you didn't and you put it in your bank account, it's liquid. If you've invested it inside of, let's say, a stock or a bond, simply call your broker and say, I want to sell that stock or that bond. And when you sell that stock or bond, it will become cash. And once it's cash, you will have the asset. So you will have it as cash. That's liquid. And then you can, make a gift if that's what you want to do. Or, if not, I don't know. I guess you're just looking to make a gift at that point to your family members out in another state. So I think that's exactly how that works. So I hope that helps a little.
Mr. Lutsky, it's been a pleasure speaking with you today. Thank you so much for the time, and we will be catching up with you after the Christmas holiday.
That sounds great. You have a great holiday. All of you have a great holiday, and thank you.
The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated. This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. Early estate planning can have many benefits, especially if you want to protect the assets that you've worked so hard to attain. If you're retired or nearing retirement and you haven't done your planning yet, you could be missing out on benefits that can save you thousands of dollars. But there's another advantage. Doing your planning the right way might also help you eliminate your estate taxes. Cushing & Dolan are experts in elder law and taxation, and they have a new guide out this month called A Tale of Two Objectives: Reducing Estate Taxes and Increasing Asset Protection. In it, you'll learn how to keep your assets in your family and avoid probate while potentially eliminating your estate taxes. Call 866-848-5699 and get your free guide. That's 866-848-5699. Or you can request your copy online from our website, LegalExchangeShow.com.
Still a lot to come in hour 2 of the Financial Exchange, including a little bit of chatter about what is going on at the Suez Canal, or rather what's not going on at the Suez Canal these days. We'll talk about what that means for the future of supply chains in 2024. We'll also talk a little bit about what is going on in commercial real estate land, specifically with the urban office market just continuing to see some struggles. So we'll talk about how long those struggles might go on, because, look, 2023 has not been a particularly good year for office real estate. 2024, not really looking like it's going to be that much better here. The other news that we have from the IRS yesterday, big one that we're going to be covering here, is that the IRS said that it would waive nearly $1 billion in certain penalties that taxpayers owed. We'll talk about what those penalties are and what you may need to do in the event that you feel that you might be in a case where you want to see one of those penalties waived. And then we'll also be talking just a little bit about what is going on with Comcast in our Data Breach of the Week. That's right, it's back. Coming up in just a little bit on the Financial Exchange. Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a new guide available this month titled The Key Numbers to Know for 2024. Mike, when it comes to how much someone can contribute to a 401k plan or 403b plan next year, what do those contribution limits look like?
Yeah, so you're getting a slight uptick from 2023, where it was sitting at $22,500. You're now going to be up to $23,000 for those 401k contributions. And in addition, if you're over the age of 50, you're going to get an extra $7,500 that you can potentially put in there. All of that is before any sort of employer contribution or match. So you're now getting up to $30,500 in total if you're over the age of 50.
Mike, what about for folks who don't have access to an employer-based plan but instead need to contribute to an IRA or traditional IRA?
Yeah, so that's where those limits are much, much lower. So this coming year in 2024, you're looking at a $7,000 contribution limit for traditional and Roth IRAs. There are all sorts of rules around this in terms of income phase-outs, who can contribute, if you're employer-sponsored or not, if your spouse is employer-sponsored or not. So there are some tricky pieces here. There is also a completely different set of rules and limits when it comes to self-employed individuals. So definitely other things to know if you maybe own your own business and have a SEP IRA.
Our guide this month is titled The Key Numbers to Know for 2024, and it talks about some of the many changes happening when it comes to contribution limits, cost of living adjustments, and other numbers. 2 ways to request it. The first is by calling 800-393-4001. The second is by visiting ArmstrongAdvisory.com. That number again is 800-393-4001. 4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you retired like me and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it and your property. If you owe the IRS back taxes or you haven't filed in a while, the tax relief line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right. If you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Finding great candidates to hire can be like, well, trying to find a needle in a haystack, but not with ZipRecruiter. Its powerful technology actively finds and invites qualified candidates to apply to your job. So while other companies might deliver a lot of hay, ZipRecruiter finds you the needle in the haystack.
See why 4 out of 5 employers who post a job on ZipRecruiter get a quality candidate within the first day. Try ZipRecruiter for free at ZipRecruiter.com/free. That's ZipRecruiter.com/free.
At Consumer Cellular, you get the same exact coverage as the largest carriers, but for up to half the cost. Same thing, up to half the cost. Up to half the cost for the same thing. 50% the money for 100% the same thing. I hope I'm making myself clear. Consumer Cellular. When freedom calls, we're here to answer. Call us at 1-888-FREEDOM.
Half the cost savings based on cost of Consumer Cellular single-line 5GB data plan with unlimited talk and text compared to lowest cost single-line postpaid unlimited talk, text, and data plan offered by T-Mobile and Verizon May 2023.
Early estate planning is crucial if you want to avoid massive tax consequences and protect your assets. Cushing & Dolan are experts in estate planning and taxation, and their new free guide can help you do just that. It's called A Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. In it, you'll learn how to keep your assets away from the nursing home while reducing and potentially eliminating your estate taxes. You've worked hard to provide for your family, so if you haven't done your planning yet, call Cushing & Dolan today at 866-848-5699 and get this free guide called The Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. That's 866-848-5699. Or you can request your copy online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
It happens all over Massachusetts. in every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, and Tucker with you, and markets are doing a whole bunch of nothing overall. The Dow is down 8 points, the S&P's up 3. NASDAQ's up 42, so not much movement there. We do have oil prices bouncing back up and gasoline futures as well. So the hope of national $2.99 gas by the end of the year, probably dead unless we see any kind of imminent reversal here. But gas prices now up about 2 cents in the last day from $3.08 to $3.09 and 0.7 of a cent on the AAA national average. We've got gold down $6.30 an ounce to $2,045.80, and that is what we have going on in markets today.
So oil going up, Chuck, over the past few sessions, not dramatic, but several percentage points now. Supply chains tightening and potentially tightening further with Red Sea turmoil and routing tankers around the southern tip of Africa, stuff like that. These could boost headline inflation, but they're not something the Fed will likely react to. I know you didn't ask, but I thought I'd insert that since we're talking about commodity prices and their big swings.
No, and this is great. It leads right into our next segment, which is talking about what's going on in the Red Sea. So, for those of you who are unfamiliar with geography, the Red Sea is a nice little, relatively narrow bit of salt water that at its peak I think is maybe about 200 miles wide. I think most of it's probably about 150 miles wide or so. And on one side, on the west, it's bordered by Egypt, Sudan, and Eritrea. And on the east, it's bordered by Saudi Arabia and Yemen. The problem that we are seeing at the moment is Yemen. Specifically, the western part of Yemen is largely governed by a group of Yemenis called the that's what it's. I had to pause for a second. Called the Houthi rebels, who do not like the normal Yemeni government, and the Houthis are not really the nicest people on the planet. If you look at the slogan of their movement, it is "God is the greatest, death to America, death to Israel, and a curse upon Jews." So they're not the nicest people, is what I'm trying to say. And they've got this habit in general of launching drones and rockets at basically anything that comes near them, just trying to get people to pay attention to them. And what has happened recently is they've gotten more aggressive with the conflict in Israel over the last couple months. They've been lobbing rockets over Saudi Arabia pretty much towards Israel. And then they've also been shooting at pretty much anything they can find in the Red Sea. They've also been trying to board ships in the Red Sea using helicopters and boats and things that they have, because again, in 2023, upstart rebel groups are not just sitting out there with muskets at this point. They have access to a wide variety of pretty impressive military technology. And so in the last week, a number of major shippers, from Maersk to, even just BP, the oil company, have said, guys, there's too much risk going through the Red Sea right now because these Houthis are they're throwing all kinds of stuff at us. We're not going to do this anymore. And so instead of ships transiting through the Red Sea after, either A, loading up on oil in the Persian Gulf, which is on the other side of Saudi Arabia, that's on the east, like the northeastern side, instead of going, around Oman and Yemen and then up through the Red Sea and the Suez Canal, they're saying, you know what? We're just going to go straight south. We're going to go, down around the Horn of Africa, around Somalia, and then down around South Africa and back up, because it's just too risky for us to be taking all this cargo through the Red Sea right now. We just can't do it. And the estimated cost increase that you see on this is somewhere in the ballpark 20 to 25%, just because that's how much more expensive it is for, the fuel and the time and everything to go around. And so in response, the United States and about a dozen other countries have announced that they are sending all kinds of military firepower to the Red Sea to shoot down drones, shoot boats out of the water that are coming out and this and that, and pretty much provide the kind of protection that is needed in order for commerce to actually go through the Red Sea again. This, believe it or not, is actually the typical mission of the Navy during most non-wartime environments, which is, hey, the U.S. Navy, by and large, is a force projection group that is largely, for 99% of the time out there, involved in making sure that the seaways are clear of any threats. That's what they really do for most of the time. So they're built for this mission, kind of in a different way, because again, they're shooting down, drones and rockets instead of just dealing with, boats at this point. But it is what the U.S. Navy is built to do. You'd prefer not to have it, doing it quite this much. But the thought that I have on this, Mark, is that more than likely, when you look at this, when it's all said and done, I suspect this is probably a short-term, meaning 2 to 4 month disruption at most to these kinds of transits, and you likely will see transits up the Red Sea through the Suez Canal resume once it has been, deemed to be safe enough by container ship companies and, oil tanker companies and so on and so forth.
I'm interested in the impact on headline inflation. Again, not underlying inflation, because you got to filter out shocks like this. But stuff like this is a relative, will represent a relative price change. Anything going through there will get more expensive relative to everything else. Just like COVID represented a big relative supply chains and the price of certain price change in the price of certain goods that were sensitive to supply chains impacted by COVID. So short term, this will probably be inflationary. It's like we were talking about in the last hour. Some prices are sticky. They don't move. When a price goes up by a lot and everything else is sticky, that pulls the average up. That's probably what will happen here. Energy prices are rising, shipping costs are rising. There's a global supply chain index produced by the New York Fed. They got this out in a hurry once COVID inflation became entrenched. And it's spiking's a little bit of an exaggeration, but it's headed up. So it'll be really interesting to see how this plays out and how the Fed responds. I doubt they'll respond with actual tightening, but it could put a spanner in the works if you're in the camp that thinks the Fed is going to somehow is going to cut rates in March or June. Depends on how long this takes to play out.
Yeah, the other thing to remember is not everything going across the ocean travels through the Suez Canal. Jeffries has a chart that shows, hey, what portion of trade uses the Suez Canal. It peaks at about 21% with container ships. Oil products, only about 12% of them go through there. LNG, about 11%. LPG, which is... What's LPG?
I don't
know. Let's see. What is that? Is that just like propane? What is that?
Liquefied petroleum gas.
I wonder
is that
what
you're talking about?
I don't know what LPG is. I don't know how it relates to LNG. I don't know what the difference is because I'm a novice at this. Tucker, what's the text line that people can text us if they've ever been on an LPG ship?
617-362-1385.
Okay. Crude oil, only about 8% of trade goes through the Suez Canal, and dry bulk only about 5%. So your stuff that's going from China to L.A., it's not impacted by this.
Yeah,
it doesn't go that way anyways.
It just says ships that are designed to carry liquefied gas.
Okay, so there's that. I still don't know what makes it. I guess it's got to be liquefied gas that's not natural gas, but I'm not sure what that is in this case.
They're designed to handle high pressure.
Well, so am I, but I can't carry this stuff, I mean, we'll see what it is. Distance-wise, let's say you're going from Singapore to Rotterdam, one of the most popular
and who
routes
has
in the I'm actually serious. This is one of the more popular routes in the world because Rotterdam, I believe, is the biggest port in Europe, and Singapore gets a ton of stuff that passes through on its way from China and Japan. Going through the Red Sea, it's 8,300 nautical miles. Going around Cape of Good Hope, it's 11,758. So again, you're talking 25% longer, and the round trip voyage takes 43 days instead of 34. Again, 25% longer. Now, the other thing to remember on this, there is a glut of container ships at the moment. What we're seeing right now is that you've got too many container ships out there because, remember, people aren't buying as much stuff. So you've got that working in the opposite direction on all this when you're trying to figure out what the impact is. Long story short, as Mark said, it's probably somewhat inflationary in the short term, but how does that actually print? How does it show up, and how long does it last? Unclear at the moment. But in case you're wondering why companies don't want to ship stuff through the Suez Canal right now, it's because a bunch of rebels in western Yemen are lobbing everything they can into the Red Sea trying to hit boats. It's pretty much what it is. Let's take a quick break here. When we return, we're going to be joined by Michael Santoli from CNBC talking markets after this.
The Financial Exchange has a brand new text code. Text us at 617-362-1385 and keep on top of breaking business news all day long. This is the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. As another new year approaches, we've put together a brand new free guide that will walk you through the key numbers you'll need to know for 2024, especially from a tax standpoint. This guide outlines the marginal tax brackets for both married couples and single individuals, and it includes details about the new standard deduction, information that will be pivotal for your financial planning strategy. We also explore other areas like Medicare Part B premiums and all the ways your Social Security benefits are taxed. Call us today at 800-393-4001 and request your free guide. The year may be ending, but it's not the time to put your financial needs on hold. Call us at 800-393-4001 to get your guide or request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
This is Tucker Silva of the Financial Exchange, and I'm joined today by estate planning attorney Todd Lutsky from the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about estate tax reduction and asset protection strategies that can help reduce or eliminate your estate taxes. Todd, there are some high net worth clients that would like to reduce the size of their estate, but they don't want to give up access to their assets. Is there anything they can do?
There actually is. Now, we talk about, doing estate tax planning, which I tell you should always do. So even higher net worth clients should put together their basic estate planning. I call that the foundation of their estate plan, of anyone's estate plan. And for higher net worths, to be using, revocable trust. There may be one or there may be 2, but you want to put those together first. And that helps us shelter what we can. But to leverage your estate tax exemption that is going to be going down in 2026 to about, $6.5 million indexed for inflation, how do we use it? We can gift it. And if you gift it away, think about what you want to gift, but you can put it into another trust called a gifting trust, a spousal lifetime access trust that allows the spouses each other to enjoy what's in the other one's trust, but you've effectively given away the asset. So all that you've given away plus all the growth will be estate tax free moving forward, and it can even skip a generation from there. So planning is critically important.
The law firm of Cushing & Dolan has been helping families like yours for more than 30 years. Request your copy of Todd's brand new guide. It's called The Tale of Two Objectives, Reducing Estate Tax and Increasing Asset Protection right now by calling 866-848-5699. That's 866-848-5699. Or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play the Financial Exchange. This is the Financial Exchange Radio Network.
All right, let's do a little bit of trivia. It's brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m., including half-price boneless buffalo wings, half-price spinach and artichoke dip, and half-price warm pretzels dipped in beer cheese. Gather with friends any day of the week at Applebee's and say hello to half-price appetizers served late night, because half off is just more fun. Now, that's eating good in the neighborhood, void where prohibited, dine-in only. Well, on this date in 1946, It's a Wonderful Life premiered in New York. The movie is beloved now, but in its time is considered a major flop. It wasn't until the early 70s when the movie entered the public domain that it became a hit, because stations could air the movie without having to pay licensing fees. The film was Jimmy Stewart's comeback to Hollywood after serving in the Army during World War II. Trivia question today: what was Jimmy Stewart's rank in the Army when he concluded his service in World War II? Once again, what was Jimmy Stewart's rank in the U.S. Army when he concluded his service in World War II? Be the fifth person today to text us at 617-362-1385 with the correct answer, and win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Applebee's. Be sure to include the keyword Applebee's in your text, and we'll give away that Applebee's gift card on Friday's show. 617-362-1385, and the fifth correct response will be our winner. See complete contest rules at financialexchangeshow.com.
Tucker, we good to go with Michael, or still waiting?
Still waiting.
Okay. Mark, let's talk a little bit about the office space next year. It's been a tough 2023 for office building owners. And in 2024, it's hard to see anything that changes it dramatically just because, well, we're still kind of in the same economy that we've been in for the last couple of years now. Office vacancy rate now nationally at 13.6%, up from 9.4 at the end of 2019, according to CoStar Group, and they think it might actually peak above 17% by the end of 2026.
Yeah, hard to say what this means for the broader market of, say, publicly traded real estate trusts that you might have exposure to through your 401k plan. Most are very well diversified. Office is probably around 10% or less or a little more, depending on whether or not they're actively managed vehicles. So, for most people who are invested in a well-diversified, publicly traded, say, stock fund, you might have a little bit exposure to this kind of stuff. So investment implications, all else equal, always an important caveat, are likely to be small. But, you wouldn't want to be on the hook paying 7-8% for something you bought 3 years ago, valued 25% higher than it is today, when you're forced to borrow at 7-8% that is today relative to the 3% you borrowed to buy the building. Just all the forces moving in the wrong direction for investors in this niche segment of the real estate market.
And I think it's challenging also just to get a handle on people. I keep having people ask, well, look, how bad is this going to be for the economy? And I say, I don't really know, because
of course.
Office is not a monolith. It's not something where you look at it and say it's the same, even within parts of a region. The office market in Boston is completely different from the office market just in Marlborough, Massachusetts, just 25 miles west. So it's really challenging to figure out what the actual damage is going to be on this.
Right.
And the other piece that I come back to is, unlike 2007, where you had all these adjustable rate mortgages that were taken out in like 02 and 03, and they were resetting in 07 and 08. It's not the case with office leases.
I mean, look, Chuck, there could be models out there, say those that the Fed is using, that suggest bigger and badder implications than my sort of first blush impression of this suggests. And that's one reason why the Fed is so anxious to jawbone financial conditions looser when they were already loose. And despite the fact that core inflation by most measures is not yet at target, nowhere near target by some, I'm trying to rationalize, trying to explain what the Fed has done over the past few weeks, loosening financial conditions, talking up the stock market, which is done very effectively. Markets are up, broad equity markets up 12% this month. We all know the story with interest rates plummeting. These things make financial conditions looser, which goose demand. Why would the Fed be doing that? Are they more concerned about pockets of weakness here and what this implies for, say,
Maybe.
the banks that lend to these companies? I don't know.
I thought that Powell kind of got at that last week, and we talked about this a little bit, but he said, and we talked about why this might not be right and why it's a completely asymmetric approach, but he said, look, you want to be, cutting rates before you get to 2% inflation because of the lags that we have. And one way to read that is, oh, gee, do they think if we get to 2% inflation, it's going to go further because something bad is coming? Maybe, but again, it's the Fed is making a bet that without these cuts, the economy was going to weaken further than they wanted it to. Is that fair?
Or they think inflation is very correlated with itself from period to period. Said differently, there's inertia. So if you're blowing past 2.5, whatever, I'll quibble with their measure of core at a different point. But suppose that's a valid measure of underlying inflation, and you're blowing past that, there's a high probability it'll continue to go down. So he's acknowledging that reality. It does seem like a strange look. He's a man of the markets. He's not an academic. He's from the private sector. He should know how markets, and he does know how markets are going to respond to what he says. So I assume that boosting financial markets, which is what his comments did, was deliberate on his part. He must have some reason for. I'm critical sometimes of his economic incoherence, but at the same time, he's smart and he knows markets. He must have some reason for doing what he did.
Speaking of markets, taking a look at them right now, we got the Dow up 26 points. We have the S&P up 3. NASDAQ still up 41. So all three major U.S. markets slightly in the green, just a wee little bit at the moment. Russell 2000 continuing its strong run of late, up about 0.2% today. So that actually the strongest of the commonly discussed U.S. indices. 10-year Treasury is down 1 basis point to 3.91%. I believe we have a 20-year Treasury auction that's going to be taking place this afternoon. So we'll see if we glean any information from that in terms of, hey, is there still demand for these bonds that the U.S. is going to be issuing, even at rates that are now, in some cases more than a full percentage point lower than they were a month and a half ago. Let's take a quick break here. When we come back, we got the trivia answer, and we're talking.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Financial planning is a year-round job, and with 2023 coming to an end, it's the perfect time to take a hard look at your strategy and what changes you may want to make going forward. Hi, this is Chuck Zodda from the Armstrong Advisory Group. We've written a brand new guide that'll help you understand some key numbers that may affect your planning next year, like marginal tax brackets and retirement account income limits. If you're retired or getting ready to retire, there's also information about how the government taxes your Social Security benefits. Get your copy of this new guide called Key Numbers to Know for 2024 right now by calling 800-393-4001. That's 800-393-4001. You can also request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange, and I'm joined today by estate planning attorney Todd Lutsky from the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about estate tax reduction and asset protection strategies that can help reduce or eliminate your estate taxes. Todd, there are some high net worth clients that would like to reduce the size of their estate, but they don't want to give up access to their assets. Is there anything they can do?
There actually is. Now, we talk about, doing estate tax planning, which I tell you should always do. So even higher net worth clients should put together their basic estate planning. I call that the foundation of their estate plan, of anyone's estate plan. And for higher net worths, to be using, revocable trust. There may be one or there may be two, but you want to put those together first. And that helps us shelter what we can. But to leverage your estate tax exemption that is going to be going down in 2026 to about, $6.5 million indexed for inflation, how do we use it? we can gift it. And if you gift it away, think about what you want to gift, but you can put it into another trust called a gifting trust, a spousal lifetime access trust that allows the spouses each other to enjoy what's in the other one's trust, but you've effectively given away the asset. So all that you've given away plus all the growth will be estate tax free moving forward, and it can even skip a generation from there. So planning is critically important.
The law firm of Cushing & Dolan has been helping families like yours for more than 30 years. Request your copy of Todd's brand new guide. It's called A Tale of Two Objectives, Reducing Estate Tax and Increasing Asset Protection right now by calling 866-848-5699. That's 866-848-5699. Or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. For your chance to win our daily trivia contest, text us at 617-362-1385. Complete rules are available at financialexchangeshow.com. This is the Financial Exchange Radio Network.
As promised, we're now joined by Michael Santoli from CNBC here to talk a little bit about what is going on in markets. Michael, thank you for joining us. According to my math here, which I think is right, the last 36 trading days have seen the S&P 500 rally 16%. That would seem to me to be a rally that most people think is getting long in the tooth, but it just keeps chugging into year-end. How does this thing still have legs here?
Yeah, it absolutely been an incredibly persistent rally. In fact, that 36-day gain ranks among the top 10 of that over a similar period over the last 30 years. So, yes, clearly there's this show of very sudden momentum. And I think you have this combination of signals that says, yep, kind of come pretty far pretty fast. Market's running a little bit hot. You could look at that at a lot of the technical readings. On the other hand, you only tend to see these kinds of rare extremes and this sort of display of this kind of buying demand and momentum when the market is in a longer-term uptrend. In other words, it usually has decent forward implications, and rarely do you see it if the rally is a pure head fake. So you kind of have to have two contrasting thoughts in your mind at the same time, which is you got to expect this market to pull back. At some point, sentiment is going to get a little bit over-optimistic. Maybe it already has. Short-term money looks like it's a little bit over-aggressive, and maybe it's after the first of the year, or maybe we've pulled forward some of the late December rally. But in general, given the fact that the average stock, the equal-weighted version of the S&P 500 has been unusually strong as well, gone from a 52-week low to a 52-week high so quickly, it shows you there's something behind this beyond just a reflex.
What about what we're seeing in places like small caps as well, which as recently as October, Russell 2000 was down 6.5% in late October for the year, and now is sitting here up more than almost 15% for the year here. It would seem to me that that's something that tends to be a rather optimistic sign for 2024 as well.
It is. There was this very rapid collective recognition, or at least a bet, that if the economy is genuinely in decent shape, and the Fed has essentially told you they're not going to try to bleed the economy to get inflation lower, they feel as if they're going to have the room to just be patient and flexible and maybe even cut rates next year without a recession, then it meant that the cyclical parts of this market were just in the wrong spot. They had really been weighed down by this idea that the cycle's on borrowed time and it's probably going to end soon. So not to say that the market suddenly has it perfectly correct and the soft landing is a lock, but it's clear that there was this rapid readjustment possible. I also always come back to the idea that you can now, and for years now, have been able to trade the equal-weighted S&P or the Russell 2000 with the click of a mouse. You don't have to go and buy a few hundred or thousand stocks, and it can happen quickly. It's a spring-loaded market.
When we look at what's going on here, we'd be remiss if we didn't talk about the interest rate side of the equation here, which has also seen a rapid compression there. The 10-year has gone from right around 5% to 3.9 in the last, in that same period, about 36 days. Is there any concern that with economic data over the last couple weeks coming in a little bit stronger than earlier in the quarter, you might be due for a rebound in yields as well?
Or at least a firming up of yields, I suppose, yes. Yeah. I've been surprised at how deep that this has come in a short period of time. A lot of folks I follow thought maybe 410 on the 10-year Treasury would be a place it would stop and hang out for a little while. But I do think what you did see is a collective recognition that 2+% inflation-adjusted yields on the 10-year were just too attractive, and people just grabbed at it and rotated into that as income. Yeah, I do think that at this point it's a tougher trade to get much lower than here than the high threes for the 10-year. So a lot of things have been working in favor of the market, right? It's obviously how deep the yield decline has been. Oil breaking down now, maybe it's got a little bit of a bid to it. And we did see this attitude adjustment that said inflation is just going to have this downside momentum and you can rely on it. So anything that complicates that picture clearly could create the means for a gut check for stocks.
Last question for you, Michael. One of the major stories this year has been AI, and obviously the Magnificent Seven driving a lot of S&P 500 and NASDAQ performance forward. When we look into 2024, what do those companies have to do to be able to even come close to matching the type of things we've seen from them this year?
I mean, I wouldn't view them necessarily purely as a block, even though they've sometimes traded that way.
Sure.
I think the market craves an ability to have more direct plays on AI besides NVIDIA, Microsoft. And so we'll see. Now, those companies are also expected to deliver an unusually high proportion of the projected earnings growth for next year. So it's not just happening on hopes and prayers, but I do think you have to start seeing tangible stuff. The reason Microsoft trades at 30-plus times earnings is because people say, well, they're charging $35 per person to use this chatbot Copilot, right? That's sort of a visible, transparent. We see how that drops to the bottom line. More companies have to be able to show that rather than just have this idea that, hey, we're investing heavily in AI.
Very good. Michael, thank you so much for joining us today. We appreciate it. Have a great holiday season, and we'll talk to you soon.
You as well. Thanks so much.
That is Michael Santoli from CNBC.
All right, let's pay off for our trivia question today, which was, what was Jimmy Stewart's rank in the U.S. Army when he concluded his service in World War II? That would be a colonel. Jimmy Stewart began his service as a private, but finished his time in the war as a colonel. Stewart became one of a small group of Americans who rose from private to colonel in only 4 years. Stewart stayed active in the military after the war and was eventually promoted to brigadier general before retiring from the Army in 1966. Jay in Centerville, Mass. is taking home our Financial Exchange Show t-shirt, and Jay's also registered to win a $100 gift card to Applebee's, which we'll give away on Friday's show. And trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m. because half off is just more fun. Now that's eating good in the neighborhood. Void where prohibited. Dine in only.
Mark, how often do you pull open the old computer, say, hey, I'm going to see how much is in the 401k?
Only if I think there's been an error in payroll. Otherwise, not much. Maybe once a year, reevaluate. That's about it.
I'm in the same boat as you. It's something where it's very much set it, forget it, and just let it go. And there is a piece in the Wall Street Journal today. It's titled, Your 401k is Up. Again, this year, hopefully, given what markets have done. Don't let it go to your head. And I think this is an interesting one where a lot of times people talk about, hey, when the market's not doing well, don't check your 401k because you might do something stupid. And this makes the case that you can also do stupid things when it's up, such as, getting overexcited that money is never going to go down, or, maybe you say, oh, gee, I'll just, use some of this because it's been such a good year, even when you're not, near retirement, and you might have penalties and things like that. So I think this is kind of an interesting take on this in terms of, look, even when things are going well, don't get too attached because markets, as we've talked about quite a bit, volatility is a feature in equity markets, not a bug.
Yeah, it's necessary to get high returns. You wouldn't buy stocks. This is a bedrock principle of finance theory.
Yeah.
Stocks return more than bonds because their returns are more uncertain. So you can't both say, although people often do, stocks will return more than bonds do. The financial advisors say that a lot. The right way to phrase it is they're likely to. Otherwise, why would you own them? You would take the risk-free, say, coupon from a treasury bond. Similarly, you wouldn't own small company stocks. You talked about the Russell 2 with Mike Santoli. You mentioned it earlier as well. The Russell 2 is our benchmark for small company, smaller-sized U.S. equities. It's more volatile. It jumps around more. Its returns are less evenly spread out than large company stocks are. You would expect to be compensated for that as an investor. And indeed, for decades, investors were compensated with higher returns on small cap equities. That so-called premium or the small cap effect has waned, maybe gone away. We don't know over the past couple decades as everybody discovered it and decided to pile into them. But you should be compensated for risk you can't diversify. A fundamental principle of finance.
Also, I want to get to this one, this segment. The IRS is getting rid of nearly $1 billion in penalties for taxpayers for late payment penalties. I'll quote here from the Wall Street Journal. Roughly 4.6 million individual taxpayers who owe for tax years 2020 and 2021 will be eligible for the penalty relief. The IRS is extending the olive branch because it stopped sending out collection letters during the pandemic. It hoped the letter halt would help struggling taxpayers and reduce its backlog. And so, according to this piece here, the penalty relief applies to taxpayers who owe under $100,000 in taxes for 2020 or 2021 and received an initial balance due notice on or before December 7th, 2023. So, looking at the math here, according to the IRS, there are about 18.6 million individual taxpayers who owe the IRS about $316 billion. This is saying, look, a quarter of you owe so little, and it's over this period that was kind of challenging. We're not even going to try to collect it from you. Instead, the remaining 14 million people who still owe $315 billion, yes, we're interested in you. So that's what we're seeing here as far as the numbers go on this.
This after the fact choice to not enforce the law seems a little arbitrary and potentially, I don't know, risky. Like, why should I pay if I owe very little? Why pay on time?
It's a little moral hazardous, isn't it?
It seems that way. It seems a little unfair and arbitrary. But look, I wouldn't be complaining if I owed money. But in the future, if there's a crisis, might you, if you only owe only a small amount, and you're a little hard up, maybe delay paying in the hopes of after-the-fact forgiveness? I don't know. Seems, again, arbitrary.
Interestingly, and this is from a data table from the IRS has 20,000 individuals that they believe owe $1 million plus in taxes.
Wow.
20,000. Imagine owing $1 million in taxes. I mean, first, it does mean that you had to have made a ton of money in order to owe that. But imagine just sitting there with that kind of stress. Like, you go to bed every night and you're just, I owe $1 million in taxes. Like, it's the last thing that goes through your head every night before you go to sleep, if you can sleep.
Yeah, I don't want to generalize about people in that situation, but you either had, like a massive business failure, so you did really well, then you had a massive failure and couldn't come up with the money, or you were playing fast and loose with the rules.
So, along those lines, I know somebody, I don't think he owes quite this much. I'm pretty sure it's like high five figures. Made a bunch of money trading crypto back in 2021.
Huh.
Decided that he was going to, quote, diversify in 2022. Realized a bunch of capital gains on his crypto. And then everything that he went into, like all these other, cryptocurrencies, went down. And so he did not have money to pay his tax bill because it's not there anymore.
And he won't he won't lock in the losses to offset the gains, or can you not? Are there limits?
You can't you can't take a loss today to offset a previous gain.
It has to be in the same period.
Or
Is
losses can be carried forward to offset future gains.
But not backwards.
But you can't carry them backwards. At least in most cases. There are a couple cases in the tax code where you can do it, but cryptocurrency losses are not one of them. So there's that. Let's take a quick break here. When we come back, we'll do a little bit of stack roulette.
This is your home for the most comprehensive coverage of the economy and the trends on Wall Street. This is the Financial Exchange Radio Network. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I served proudly in the Marine Corps from 1981 to 1984 and was honored to receive the U.S. Marine Corps Expeditionary Medal, one of the oldest decorations still issued to active duty personnel. I started Veterans Development Corporation to give back to the veteran community. Many of my employees are former veterans, and it is my distinct pleasure to work with them each and every day. This is why I'm so excited to be partnering with the Disabled American Veterans veterans, Department of Massachusetts, on this year's DAV 5K. If not for the DAV, many of our disabled veterans would not have access to critical services that they need to live comfortably. I hope that by telling my story, many more of our veterans will achieve their goals and dreams post-service.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit DAV5K.Boston. Early estate planning is crucial if you want to avoid massive tax consequences and protect your assets. Cushing & Dolan are experts in estate planning and taxation, and their new free guide can help you do just that. It's called A Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. In it, you'll learn how to keep your assets away from the nursing home while reducing and potentially eliminating your estate taxes. You've worked hard to provide for your family, so if you haven't done your planning yet, call Cushing & Dolan today at 866-848-5699 and get this free guide called The Tale of Two Objectives, Reducing Estate Taxes and Increasing Asset Protection. That's 866-848-5699. Or you can request your copy online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. If you missed any of today's show, catch up whenever you want on our YouTube page. Find daily show segments and full shows. Just go to youtube.com and search for The Financial Exchange. This is your home for breaking business and financial news. This is the Financial Exchange Radio Network.
Mark, what do you got for me for Stack Roulette?
Just a public service announcement of sorts, I guess, Chuck. Comcast reported in the Wall Street Journal saying data of 36 million accounts was compromised in a breach that includes those who have Xfinity home service. I don't know about Xfinity Mobile, which I have, but either way, if you call the line, they'll tell you in very passive terms. It's not clear that in individuals, for example, in my case, it wasn't clear that my data was stolen, but they're sort of strongly urging users to change their internet password and activate two-factor authorization. If you haven't seen this notice, and you probably haven't because they didn't actually send one, which is odd. You have to call the line to get the notice or read the Wall Street Journal. Go online if you're an Xfinity subscriber, change your password.
Yeah, we used to do a whole segment, our data breach of the week. They haven't been quite as common, at least the big ones. I know that there still are quite a bunch of hacks that go on a regular basis, but this is a pretty big one. Again, you're talking 36 million people here, so Yeah.
And Chuck, what do you tell people? Go on Experian, TransUnion, etc. Freeze your report so nobody can take out credit in your. What else can we? I'm sorry to put you on the spot here, but
yeah.
What's the top one or two things you tell people to do so that when the inevitable breach happens, even if somebody's got your address, the last 4 digits of your SOCH, and other personal identifiers, they can't take out credit in your name, which is probably everybody's biggest fear.
Yeah, I think big thing, have your credit frozen. It doesn't cost anything anymore. Ever since the Equifax breach, it's now, I believe, free across all the major bureaus to freeze it. Other things just online, use a password manager that makes really complicated passwords so that you don't have to remember them, and they're different for every site. That way, if one site is hacked, you don't have the same same password for another one. Along those lines, if you're using a password manager, use different login for every site. Don't use the same login for each site. And this way, even if someone has a password or a username, they don't match any of your other sites. So you isolate the damage there to just a single site. So those are the kinds of things that you can do in terms of protecting yourself. No one's completely safe. It's really about damage minimization more than anything else.
The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean Paradise is waiting for you, so head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Tucker, are you a drinkaholic?
What drinks are we talking about?
So I'm talking about non-alcoholic drinks,
Okay.
but specifically, there's a piece in the Wall Street Journal talking about how every fast food company is trying to roll out new specialty drinks because this is the latest trend, which is
All the fancy drinks, yeah.
Yeah, the fancy schmancy ones that are all different and everything.
Yeah, that's not me. I don't really care. I just if I'm going to get a drink out at a coffee shop or any fast food place, it's usually just a coffee or an iced tea or something simple.
McDonald's in particular, they're rolling out this new Cosmics test, and they've got all kinds of drinks there. They've got a blueberry ginger boost, a churro frap, a strawberry and cookie McFlurry, and just all kinds of stuff that's being put out there now. So, look, it's not for me. This isn't my stuff either. But there's a reason why every company out there is trying to do this stuff. Two reasons, actually. The first is there's clearly a demand for it, and the second is the margins on drinks bigger than on food.
Yeah, I could see that.
Shouldn't
what do
you
they
stick
charge?
to the
like
basics?
$5?
What are the basics, Mark?
Like, if I order 6 McNuggets, there shouldn't be a confidence interval on the menu. Like, maybe it's going to be 5, maybe it's going to be 7. I want 6. Stick to that. If I order coffee, no ice, iced coffee, no ice, nail that every time. Just stick to your knitting. Every menu innovation that they've introduced in the past, I'll broad brush this, in the past 20 years has been a flop.
I don't know. The McRib still gets me every time. Is it back right now, Tucker? Do you know?
Oh, who knows? I can't keep track of when the release comes out and the last time we're going to see it. Who knows?
Love a good McRib. Let's take a break for lunch, speaking of which. And, we'll be back tomorrow on the Financial Exchange. We'll see you then.